just the way things are playing out, there's a good chance that we'll get a relief rally fueled by short squeezes.
1979, Paul Volcker became the Fed chair, and he raised the Fed funds rate to 20%, which is insanely high.
You know who did that? Anchor Protocol. Just kidding, but yeah. For the last few weeks, the chatter has been that the last dominoes left to fall. It's uncertain of like who could come up next. Binance, Silvergate, Microstrategy, and of course DCG.
Tell us what the best part of the dopamine detox is.
I made my phone screen black and white.
Oh.
So that, why? Because the colors, they release too much dopamine, right? So like, no social media apps, no color.
That's psychotic.
You know. Good evening, everyone, and welcome back to Inside the War Room, episode number 5. It has been about 2 months since we last spoke. It was last time November 19th in the aftermath of the collapse of FTX. A lot of things have happened since. There's been a lot of smoke in the world of crypto. And also, it's been holiday season. A lot of people, tuned off, wanted to go for Christmas, for the holidays, for New Year's, and just like forget about the world of crypto for a bit. But now it's the new year. It is 2023, so we're right back in action. And there's a lot for us to cover today. As always, I'm right here with Jablonski, our head of business development at Hartmann Capital. And as usual, we're going to dive into the world of macro, what's happening in crypto, in the metaverse, and also give you a couple of updates from the firm, from us, how we're tackling 2023, and what we're looking forward to. So how you doing, Dan?
I'm good, Felix. We're back. It's a new year. As we kind of joke about, maybe it's season 2 of the War Room now, and this is a new year of 2023. But episode 5, we've gotten a lot of great feedback so far, and so definitely a testament. I think this has been really well received, and so thank you, and thanks for sharing your insights with us and hosting this.
Yeah, 100%. I think, people like the format of something that's very like real time and authentic. There's a lot of podcasts. I do a podcast myself, and it's nice to hear about founders, but this is something where like, hey, there's always so much happening in crypto. Like, hey, what's going on with FTX? What's going on with Silvergate? What's going on with DCG? And then being able to get real time insights from people that are in the space, something unique. And so hopefully one of our goals this year is to make this like a top 3 crypto resource where anybody that follows the space, this should be on your radar, that you watch the War Room, listen to the War Room wherever you are, to get really that behind the scenes insight. I love
that. And so today, to start out this episode, I want to change it up a little bit and do a fun activity.
All right.
So I'm going to list the names of some companies for you, and I just want you to tell me if you've heard of these companies or not. Okay, and I'll give you a hint just to paint it. It's from like the early 2000s, like start of the tech era. Okay. First company is called CD Now.
Sounds familiar, but probably never used, not heard of it.
Second one's called Peapod.
Nope.
MotherNature.com.
Nope.
Second to last one, drcoop.com.
Negative.
Nope. No. All right. This is the last one. This one is a little bit more popular of all of them.
Okay.
It's also, we'll talk about it in a second. WorldCom.
Yeah, that one I've heard about. Last year I was reading like a dozen different books on short selling, and that one came up a couple times. I think that was like one, like kind of up there with Enron, big fraud. I think about like $11 billion in like account, like they lied on the balance sheet about like assets, like $11 billion in assets that weren't there.
Yes. And so this was, if not the most notable, one of the most notable frauds of the dot-com bubble in the early 2000s.
And to be honest, like if I hadn't read about it, like in short selling books, I probably would have never heard of it, because in day-to-day life it doesn't come up, even though it was so massive.
And so I want to draw a comparison to the year that we just went through in 2022 and this dot-com bubble and that fraud and another fraud that we just witnessed a few months ago. But it's important to note here that as the tech bubble collapsed, all of these millions of miles of lines of fiber optic cables were laid. And this created like an infrastructure rail that allowed the next internet boom to happen. And so in 2002, no one thought that we'd ever like use all these fiber optic cables for anything. It was total waste. No one could see, of course, now 20 years down the road, 21 years down the road into the future of everything that's become. And so I want to make the case here that this same thing is happening in crypto, and the infrastructure rails are being built right now. They're being built last year. And we have invested in it now over a few years, but there's still the 20-year gap left to come. And, last year, a lot of people took a lot of crazy risks. And in 2021, a lot of people took a lot of crazy risks. And so we saw the outcome of all that, we saw the collapse of the bubble, but I think now in 2023 is where we find out what these people came up with and what's being built.
Yeah, no, and I think especially after, a handful of years, depending on what asset we're talking about, yes, there's challenges with some other layer ones, but for example, like Ethereum, still chugging along, still being used. We had a talk with the people at GameStop, and now like they launched an NFT marketplace on Ethereum, for example, right? And it's like there's all these big firms that are now building things on Ethereum. So now it's no longer just like the cypherpunks, right? And of course, a lot of that is still alive and well, focusing on privacy and so forth. But it's not the mainstream. And it's so hard to put the genie back in the bottle, to turn the clock back, because people have seen real world value in that. Yeah. And even though there was a lot of fraud and scams and bubble excitement and hype, right? There are real things that are still standing afterwards.
Correct. And I think I love that metaphor. I love that analogy. I think this is right where we're at now, 20 years later. And we've seen how much the internet's grown over the past 20 years. I mean, it's become the greatest invention of all time.
And I bet you after the .com bubble burst, a lot of people said, oh, it's going to take so long. It's going to be another 50 years before the internet takes off, right? Because that's always what you hear after bubble bursts, is that it is going to take so much longer than we think. But the reality is, Facebook was like 6 years after the .com bubble. YouTube was like 3 years after the .com bubble, and so forth. And so some of the biggest innovations happened really briefly after. And in fact, it's only been 20 years since the .com bubble. We've had a whole cycle since then. And we joked about it, because in the wake of AI, we had a late night once where we talked about how much our lives have changed since we were young, right? And I mean, we're still young, but I grew up in Germany, right? Like we would go into the gardens and fight with sticks and make bow and arrow and stuff like that. And getting a flip phone was a big deal when you became older, when I was teenager and whatnot. These things are for granted now. We've got Wi-Fi everywhere. Kids have iPads when they're 3 years old. The fact that VR is even a thing. I mean, we've come so far. And that really only 20 years. So if you are bearish on the next 20 years, I would really think about how much progress we've made in the last 5 years, 10 years, 20 years. And if you extrapolate that out, of course, there can be mean reversion, but there's very little reason for mean reversion when, you have things like Moore's Law.
I love that. So I want to jump back into our usual format now. Hopefully that was a fun way to mix it up, start it out a little bit. Since our last War Room, middle of November, on the macro front, CPI continues to record lower. We've already talked about that in numerous episodes. It's kind of expected. And of course, the Fed keeps raising. I mean, granted, now they've raised at 50 basis points instead of 75. So cut the pace a little bit. But nothing really dramatic has happened. And nothing really dramatic has happened in the market since the collapse of FTX either. So I guess if there's anything you want to talk about on the macro front, anything that you're seeing, if not, I have another tangent to get into.
I'm open for tangents.
So
Shoot.
we've been working on something over the course of, now let's call it the Hartmann Capital, last 2 months of really diving into reading books and growing, building in the bear market. This is how we build in the bear market. And I have finished both of the acclaimed Howard Marks books, 2013, The Most Important Thing, 2018, Mastering the Market Cycle. For those of you who don't know, Howard Marks, co-founder of Oak Tree Capital Management in 1995, they have become the world's largest investor in distressed securities. So across the credit cycle. I want to touch on something on the macro front because he's known for being one of the best macro thought providers in the space. And
I remember reading his letters during the COVID crash, and there was a lot of thoughts he put into the pandemic and what a post-pandemic world will look like.
Genius. Yeah. And even Warren Buffett's been quoted multiple times. Whenever Howard Marks releases a memo, the first thing he reads. So this is actually from Howard Marks's last memo, his most recent one, that he sat down to write on December 13th. And it's titled Sea Change, SEA Change. And the definition of that is a complete transformation or a radical change. So in the course of this memo, he talks about 3 different sea changes. The first sea change that he has witnessed across the course of his career came from 1969 to 1974 when he was first starting out as an investor. And he witnessed this thing, this is well before our time, now 30 years before our time, called the Nifty 50. And these were the top 50 highest capital market stocks. And it was important because when he first started out, he was told, Howard, as we're in this era of growth, you invest in these stocks and no price is too high, meaning that the company will just continue to grow and it'll catch up to it. So what he learned and what he saw as the first sea change was investors really didn't even think in terms of a risk profile.
Right.
It was just all returns, and the companies would catch up to it. Their growth would catch up to it.
Yeah, similar to how like a lot of the FANG companies make up like half the S&P 500.
Yes.
Right, because everybody thinks like that's the future, and obviously they've done really, really well. But also they were like startups a decade ago, and they're not to interject too much into like the long thought, but like one of the books I read, which was also the Acquirer's Multiple, where it talks about like mean reversion in earnings, right? Where people think, hey, most investors think this is the growth of a company, and so they say it's always going to go that way. But the reality is more competitors are going to come in. Great example, Netflix, where Netflix has been growing. Now there's a bazillion streaming services. It's leveling off, and now they're freaking out.
Yeah.
But back to you.
Sea change number 2 that he saw was about 5 to 10 years later. In 1979, Paul Volcker became the Fed chair, and he raised the Fed funds rate to 20%, which is insanely high.
You know who did that? Anchor Protocol. I'm just kidding, but yeah, the Fed actually did that. Amazing.
The Fed did that, and he did it in 1980 to beat inflation at the time. Inflation was crazy. CPI numbers were crazy at the time. What this did, and what he accounts for as the second sea change, is it sets a point in time, a period of this change that all of a sudden now, from 1980 until 2022. And remember, this second sea change happened in 1980. We're now seeing a period of declining rates because it had
from 20 down to 0 over the course of 40 years.
From 20 down to 0 over the course of 40 years. The second sea change. So that leads us to the third one. And this is the point of the memo. The third one happened very early in 2022 when Jerome Powell started raising the Fed funds rate. And of course, you kind of talked about this in your 2023 outlook and your end of year summary of 2022, but it was the fastest interest rate hike in the environment of like 35 years, this one. And now it's painting the picture for what this third sea change will look like in a higher for longer rate environment. And of course, like noting that over the course of those 40 years, the Fed funds rate was crazy high for many periods. One in which, of particular, during the 90s, the S&P 500 still returned over 250% during that time. And so what we're seeing now, though, is instead of the zero rate environment, we're seeing let's just call it higher for longer, but 5% Fed funds rate environment. So I guess the question to you is, and tailor into like the rest of our conversation and what you're doing and what you're seeing and what you're looking at, in combination with this third sea change, the growth that we're still going to see, and what investors are going to learn, and what will be built on top of, remember, those fiber optic cables that have been laid across digital assets over the last 2 years, what's going to happen?
Yeah, I would say first off, most investors and most analysts, they always overreact to either one side of the spectrum. In the bull market, it's exactly that, like with the Nifty 50, that like things will always go up forever. These are the best companies. Nobody's a chance, right? Same thing with FANG. Like nobody can disrupt them. Indestructible, right? Yeah. Growth forever. And we saw companies go for the first time. Like we didn't have $1 trillion company in 2017. And then all of a sudden we had $3 trillion companies like Amazon, right? On Apple. And so on one hand, it was that side of the spectrum. Now it's the other side of the spectrum where you've got some people saying it's the end of growth, it's the end of tech stocks, it's the end of, pretty much we're going to stop progressing for a bunch of while, for a while. And we'll kind of go back into the dark ages. Oil is going to go to $200. Everything's going to go crazy, right? And so that's kind of like the overreaction. I think the truth is somewhere in the middle where you have maybe, I said this in my write-up, tech companies will operate a little bit less like theme parks, right? I remember the first time I went to Silicon Valley, when I went to like the Facebook headquarters, the Google headquarters, and so forth. And I remember Facebook headquarters, there's even an old vlog of mine where I walked through it, and free ice cream, arcade rooms, and like everything you could imagine for free, right? Restaurants for free, right? Like they just want to make it like so enjoyable and so like that developers never leave, right? They literally stay on campus, just build and code. But the reality is, there was so much float that, probably a lot of these people didn't actually ship anything, didn't actually do anything, right? And then towards the pandemic, when we had remote work, it even became a thing that, some people actually had like 3 jobs at the same time, 4 jobs at the same time. And the employees would know, because all you have to do is log in for the Zoom call, put on the Facebook shirt, take the Facebook shirt off, put the Google shirt on, right? That was kind of the joke, right? Yeah. And at the same time, intrapreneurship was also really weak at a lot of these companies. So for example, let's say on Google's front, most of Google's innovations went nowhere, right? Google Car went nowhere. Google Classes didn't really go.
Yeah.
Google Circles, I don't know if you remember that one. Google Circles was like Google's attempt at a social network. Came out like when I was in maybe 9th grade, 10th grade, lasted a year, died. And so there was a lot of those things, right? And it's kind of similar with Facebook when you look at Facebook's most successful products, right? Most successful products, Instagram, WhatsApp, Oculus. All three of them are acquisitions, right? And so the point I'm trying to get to is that I don't like, unless you believe we're going back to the dark ages, tech is not going to go away.
No.
However, how the landscape plays out is going to change. So number one, we're moving probably back towards how Silicon Valley, like how, let's change that word Silicon Valley to like how tech used to be, right?
Yeah.
15 years ago, 20 years ago, and so forth, when you heard startup, it wasn't like this glorified thing, the rock stars of today, right? It was more like, it was guys in hoodies and whatnot, like working out of the garage, rugged, building things on like low overhead, skilled, and so forth. Yeah. That's completely changed when now, like sometimes founders, as long as they're charismatic, they can raise money and they outsource everything, right? So little talent, high expenses, company parties and so forth. I mean, just look at, crypto conference and stuff like that. Oh my God. Right? So a lot of that. Secondly, valuations are going to contract, right? Like if you just look at the numbers, I couldn't pull up a 2022 number, but I found a chart that showed like 2013 to 2018. Okay. And just from 2013 to 2018, the average Series A through Z roughly doubled in valuation. C even tripled. So for example, if a Series A used to be a 10 million val in 13, it was 20 million in 18, right? If a Series C was 100 million in 2013, it was 350 million in 2018, right? So these valuations expanded, bloat expanded, and so forth. So I think that is going to contract. Now, for us, that's fine because we only launched our venture fund last year, and so like we came in at a time when they started to contract. Plus, virtually every company we've backed was on a safe note, convertible, so that doesn't affect us. It's more problematic if you're like a 2020 vintage where you literally bought the top. You back companies, and I got those offered. There was one company that tried to get us involved at a 250 valuation with kind of pre-bought. They sold some NFTs, and I was like, "There's no way in hell I'm going to back this because, like, for me to make a return, you have to become $1 billion company." And so far, in let's say 3 years ago standards, you wouldn't probably be a $50 million company, right? And so, all those dynamics are changing. But what I'll say is this too: through this phase, you're going to have winners win in a bigger way. And I say this because in three different ways. One, there's a lot of layoffs. Right. And out of layoffs comes a lot of people that now have a chip on their shoulder. That have deep insight into an industry, that have a network, experience, and so forth. And they have time on their hands and hopefully a little bit of savings. Right. And because what we're seeing right now is really more so a white collar wave of layoffs. I mean, you have layoffs at every single tech company from, the Coinbases of the world to the Twitters of the world and so forth. Right. So it's a lot of white collar layoff. So technically, a lot of times they probably have savings. What they're probably going to do, and I already started seeing this in my friend circle, where like friends that we used to work at crypto companies, that are now saying, I'm gonna start my own thing. So they're migrating from being an employee to being a founder. And we saw this before too in 2008, where a lot of the people that maybe didn't have the best 2008, they became startup founders and they created the next WhatsApps and so forth. Worth noting, the founder of WhatsApp didn't get a job at Facebook. He then built WhatsApp, which got acquired by Facebook for over $1 billion, right? So I think that's one angle that is going to happen. A second angle is that will also help the reduce of float, and which when I say reduce of float, that means companies can operate on less capital, right? Because people say, oh, there's going to be less capital, so like we're going to contract. Yes, but also the spending will contract without you seeing a single change in product, right? Which is less competition, right? So for example, Coinbase, I think, is a prime example. You've had BlockFi go under, you've had Voyager go under, Celsius go under, you've had FTX go under. Where do you think, like, yes, there's capital lost, but also there's customers looking for a new home. Where are they going? They're going to Coinbase, right? And we saw this across exchanges, whether it was Coinbase, Binance, OKX, and so forth. A lot of these exchanges that are still outstanding, they saw influxes of capital. Right? And so then all of a sudden, if there's a less competitor that you're competing with, you don't need as much marketing spend. You don't need to like go as hard at like, sponsoring conferences and so forth. And so all of a sudden you can get more market share for less dollars spent. And so that's where kind of like, to wrap it up, is like the cream rises to the top, where in these cycles, yes, there is going to be an earnings contraction at first, which I think everybody is kind of like front selling. Everybody's afraid that, earnings across industries will come down. But then there's also going to be the backswing of the pendulum, where as competitors die and as they cut expenditures, as they have layoffs and so forth, all of a sudden earnings can actually look a lot better. And so like that's something that I think on a market dynamics perspective makes me let's call it long-term bullish, medium to long-term bullish. And then I think as long as you're an unlevered investor and you believe that technology will keep progressing, whether that is in crypto, whether it's in metaverse, whether it's in AI, whether it's in space, it doesn't matter.
Yeah.
Like the world will keep spinning and it will keep moving forward. And I guess as a final note too, we're still in high inflation environment. And so like, yes, you can put your money into treasuries, for example, and that's fine. And the irony is that in this environment, it's probably going to become more and more binary, where you're either going to put your money into treasuries to get that safe 4 or 5% return a year, or you're going to swing for the fences, because ultimately 4 or 5% still doesn't cover the 7% inflation that we have, right? Now, everything in the middle doesn't make that much sense because you're barely outperforming treasuries, but you're still taking an enormous amount of risk. I mean, just look at how even like, again, FANG stock stick did, right? So if I think it's going to be the split to the sides. You're going to have either really risk off with credit, or you're going to have really risk on with venture, crypto, and anything that's forward looking, because that's one of the few things that still has a chance to outperform inflation.
Agreed. And I mean, even from our own circles and our friends, the people that we've talked to, that's kind of what it feels like. It feels like they're either going treasuries or really long term. Venture, etc. So you hit the nail on the head there. So I guess walk me through because one of the things that I was going to say on your last tangent is like, it's all a cycle, right? It's all a cycle, and it's just depending upon like your positioning in the cycle. And so as we've talked about, and as we feel like, we're somewhere, of course, in the bottom spectrum of that cycle. We don't know if it's still got further to go or now we're going to come out. We don't know where in those 3 points, but walk me through some of the bottom dynamics that like you're seeing right now day to day. And we'll just keep it right now on the hedge fund side.
For sure.
Side.
I think we covered a lot of the macro, so just to focus in on like purely crypto for a moment, right? I don't know if we mentioned this on the last War Room, but essentially for the last few weeks, the chatter has been that the last domino is left to fall, where it's uncertain of like who could come up next, right? We talk about the bodies rising to the top of the water, right? Yeah. Binance was a name that's thrown around. Silvergate was a name that was thrown around. Microstrategy was a name that was thrown around. And of course, DCG, right? And so we can kind of like go through them one by one, because to me, when all those come out clear, or at least when that situation is resolved and there's no more bodies left to come up, right? Then there is a certain level of like relief, because investors no longer have that question mark, right? And all of these are massive, because like Binance, biggest exchange, Silvergate, biggest crypto bank at the time. And then DCG, owns like 3% of both Bitcoin and ETH via Grayscale. They don't own it, but like, people through it own it. And so all of that is like existential to crypto. Not existential, but at least like, let's say on a 1 year time frame, it could really cause damage, right? And so once those are resolved, I really do believe that the market could find a massive relief rally, which then could also lead to massive amounts of short squeeze, which we'll talk about later. But maybe we'll just walk through them one by one. So first of like Binance to me is fine. I mean, ultimately, what's it called? There was a little bit of a fuss going on, right? Because Mazars, which is also our auditor, right? They actually do an audit with us, but with Binance, they did a proof of reserves, right? Now, the problem was that CZ, when we were walking around saying, we got an audit by Mazars, which they didn't. They got a proof of reserves. Two very, very different things. And when it comes to auditing firms, they take it very seriously how things are labeled, because they don't want, let's say, the more valuable stamp of approval being misused for something that it's not, right? So like there could still be, like, the proof of reserves were clean.
CZ sounds like he works in crypto.
Yeah, right. So there's a lot of bending the things, right? But ultimately, Binance, they do with the proof of reserves. You can check on chain. They got like 60 billion in assets, and they did have outflows of like 7 billion. They service it without a problem. Yeah, I'm not too concerned because ultimately, also the next biggest exchange, I believe, is like OKX with 6 billion. So like they've got like 10x the amount of assets that the next one has. Yeah, and so yeah. I don't see anything happening with Binance. I mean, long term, I think Binance needs to find a way to collaborate with regulators. That's my biggest concern with Binance is that they already suffered some of that. I think it was like in 2019, 2020, where Binance was expanding so fast that they were fighting these battles on all fronts. They were fighting battles with Europe and in Germany. They were fighting battles with Japan and so forth. But no, some of those were lost. Some of those were won. They started getting licenses, like, for example, in places like France and so forth. And so they were making progress. But for them, let's say let's put on that 20-year classes, for them to be that behemoth player over 20 years, they do need to start, collaborating more with regulators, right? And so on one hand, like maybe they don't collaborate as much as they probably should, but at the same time, I do think they're running a fairly clean business, fairly clean. It's crypto, so I'm putting stars next to it.
Exactly.
Next player is Silvergate, and I mean today we did huge news. If you want to fill people in, today was a big announcement that came out on Wall Street Journal, I believe.
Yeah, an announcement, and then of course overnight the Silvergate stock sold off like almost 50%, somewhere from like 23 down to 12. Two announcements. First being that during the bank run that they experienced in November of last year during the FTX collapse, which by the way, Silvergate banked FTX amongst with a whole host of other large crypto institutions such as like crypto.com, blockchain.com, Circle, etc. One of their largest clients, but FTX, there was a bank run and everybody got scared and said, we want our money out. We want our money out of Silvergate. Good news is Silvergate, as a regulated US company and a publicly traded company that is under the microscope,
FDIC insured bank, Fed member bank,
unlike FTX, was able to handle the withdrawal requests and the bank run, and they got everybody their money. Over the course of that, Silvergate had $9.8 billion in assets.
And 9.8 billion in assets.
9.8 billion in assets. Over the course of that, somewhere to the tune of like 8 billion, 8.1 billion was the result of this run.
Right.
Was taken
withdrawn. Right.
Was withdrawn. Now, granted, of course, like this was a month and a half ago now, so I'm sure Silvergate's got inflows back in. I'm sure the dust has settled a little bit, but as a result of this, let's just call it like shock to the system for them and for the company, they realized like $700 million of losses on like assets, as well as they announced they're going to lay off some staff this morning as well too. 40%. So a large amount of their staff. So they're resizing. I'll use the term restructuring. They're restructuring down a little bit with the dynamics, the new environment, and what had happened.
Yeah. It's worth noting, Silvergate has perhaps the strongest relationships across the crypto space when it comes to banking, exchanges, funds, and so forth. They also have what's called the SEN network, the Silvergate Exchange Network, which allows you to 24/7 transfer fiat, right? So for example, it could be a Sunday night, right? And I need to get some money on Coinbase. I can do that, right? Yeah. And it happens pretty much within an instant. That's a huge like business mode for Silvergate, even with all that's going on. Yeah. And you already said it, but I think it's worth noting that even though like an analyst will look at this and say, "Oh my God, they lost almost 90% of that." No, they lost more than 90% of that. Something to that tune
during this one period in time.
Period of time, But I also understand what went through people's heads because we were all playing defense. We're like, who's going to go down next? I already lost money on FTX. I'm not going to lose money on my bank, so let me just move this somewhere else, right?
Yeah. And granted, up until I would say like the last 2 weeks, it has been rumored that like Silvergate could go down next. Now, granted, I think some of that dust is starting to settle as well too, but they could still go down as part of this contagion.
Sure, but with every single day that passes when nothing happens, with every single week that passes when nothing happens, and with earnings coming out, I think on the 17th, and like even this report coming out, like even though that's bad, it means they're still solving. They're still in business.
They're still alive.
And so people will eventually say, okay, Silvergate's here. I like the SEN network. They're going to put their money back in there. Yeah. And so it's probably not going to go away. But more importantly, it's also worth noting that if they only have like $1.5 billion left in assets, the amount of damage they can do to crypto is becoming smaller by the day, Yeah. So like, because clearly they didn't lose 8 billion, which is good. So now all they can lose is 1.x billion. Yeah. But based on the latest balance sheet I saw, they actually are now trading below book value, where I believe they're well
below book value.
Right. The number I saw today was $1.6 billion in actual assets and a market cap of $390 million. And so that's wild. And so I think it was like 0.3 something book value. So for anybody that would buy value, I just read that book on like value investing, like that would be a great buy. But now, not a recommendation, of course, but at least I think the risk of that becoming one of those big dominoes that rips us apart is low because one, now they've got very little assets. Two, we're no longer living in a Silvergate-only world. We have Signature, we have Customers Bank, and so forth.
Correct.
And so the show goes on.
Yeah, agreed. And we always talk about like psychological mispricings or the pendulum oscillating from one side really hard to the other side really hard, and extreme greed and extreme fear. And it's easier to say play Monday morning quarterback on the outside looking in, but this could be another example of that.
Yeah. And we got a small position in Silvergate. Like I'm a believer that there can be mean reversion. Maybe not like this week, but let's say over the span of like a 1 to 3 month period, when those fears subside, when people realize, hey, they still have a strong grasp on the market, unless you believe that crypto goes away. This will likely rebound too, because it is now officially trading, I believe, at the lowest point it's ever traded since it went public. Third one.
I was gonna say, Keely, keep us on the book for a second. I know one of the things that you and I have been looking at a lot recently is MicroStrategy.
Mm-hmm.
So we had a trade on around MicroStrategy.
Yep.
Walk me through it. What was your logic? What happened? Go ahead.
Yeah. So, you know, one of my, I've always been an ETH bull. Not always been an ETH bull. That sounds like now I'm just like psychological. No. Based on a lot of factors, you know, from the fact that Ethereum is deflationary to the fact that it's the foundation of DeFi, NFTs, stable coins, to the fact that it's now ESG friendly with like, you know, proof of stake. I do believe based on a lot of these factors and more that Ethereum will over time outperform Bitcoin, right? And so there's a simple way to put on that trade, which is long Bitcoin short, long ETH short Bitcoin.
Yeah.
But I found that there's a more interesting way to express that idea, which was long ETH, which is the Grayscale Ethereum Trust, short MicroStrategy. And so I'll start with the second one since that's what you asked about.
Yeah.
MicroStrategy, if you chart MicroStrategy against Bitcoin, it's essentially been poorly performing Bitcoin since the beginning. When bull market and bear market doesn't matter.
Yeah.
But beyond just the performance, MicroStrategy is in a really problematic position where it's now the year 2023. MicroStrategy has, I believe, about $2.7 billion in debt.
Yeah.
They have about $1.3 billion in market cap, so less than half market cap than what they have in debt.
Wow.
Also, they have less in assets. So they have only about $2.2 billion in Bitcoin, which is about 99% of the assets. I think last time I checked, they had $2.2 billion in Bitcoin.
Say, the assets essentially just levered Bitcoin.
Right. Well, I think they had like 200 billion Bitcoin and like 60 million cash. But this was before they just bought more. Michael Saylor just bought another 2,500 Bitcoin. So it could be that they have like something to the tune of like $20 million in cash lying around.
Yeah.
Now, what somebody might notice is like, wait a second, there's less assets and liabilities. How is this company still in business? Well, it's because the way they structure that is that it has maturity dates in 25, 25, 26, and 28. And what's important here is many things. First of all, the ones expiring in 2025, right? Now we're only about 2 years away from that.
Yeah.
I think there's and I might mix some of these up because like they're very similar numbers. One is I think is the 650 million note, which I think has a 6% interest rate, and then you have a $205 million Bitcoin-backed loan that also has, I believe, maybe that one has a 4% interest rate. And then you have the 2028 loan with 500 million, right? Wow. So now all these combined, it's about, 800 plus 500, 1.3 billion. About $1.3 billion that are, well, the caveat is that the 2028 one has a clause that says if at any point in time, MicroStrategy has less than 130% of that loan in liquid assets, that loan will go from 2028 to 2025.
Yeah, the loan to value for it.
And so my logic is here saying like, okay, if the 650 needs to get repaid, how does it get repaid? Well, you have to sell Bitcoin to do that, right?
Yeah.
That's a lot of selling pressure on Bitcoin to do that, right? So that's going to like move Bitcoin lower, which also moves MicroStrategy's assets lower, right? Then you're also paying back the $205 million loan, right? So now you're paying back $800 million. At that point, your assets also dwindle away, and you're actually becoming much, much closer to perhaps being at risk of that, move from 28 to 25.
Yeah.
And if that happens, there's a very close chance that, like, at some point, MicroStrategy might actually need to sell most of their Bitcoin just to service those loans.
Yeah.
And now here's a beautiful thing with markets. We don't have to get there for MicroStrategy being in a bad financial position from a ticker perspective.
Yeah.
Investors just need to be scared enough of a situation like that, maybe this year, maybe next year, for there to be a major sell-off because he's saying, hey, this is a ticking time bomb. I'm not going to wait to see what happens in 25.
Right.
Come on top that they might get in trouble with regulators because like you're pretty much running like a levered Bitcoin ETF at this point, right? Yeah. And so my logic here is that shorting MicroStrategy, essentially you're shorting underperforming Bitcoin even though it's levered Bitcoin, and there is management risk and so forth. Great example was when he bought the 2,500 Bitcoin extra. All of a sudden it tanked 10% because people are probably saying, what is this guy on? Like, this is insane, right? I don't want anything to do with this asset. Yeah. And so that's kind of the short case. We initially shorted it around, I think, like 198. And then, I started seeing an up move in crypto equities. And so we closed it out in the 140s range.
Nice.
But it's certainly something I'll play a few more times because ultimately, every single, like, this is now more as a soft fact, as an anecdote. Yeah. Every single archetype that is similar to Michael Saylor has gone bust this cycle. Yeah. All the big egos, all the levered, Do Kwon, Alex Mashinsky, Suzu, like all these names, SBF. Right? Yeah, although SBF was a little bit more under the radar, but like those guys were like this super boisterous. And I mean, Michael Saylor literally at Market Top told people like in an interview, you should mortgage your house and buy Bitcoin with it. You know, I mean, he said that in an interview.
Yeah.
And so like there's a chance he can make it just because he structured that instruments appropriately, and Bitcoin rebounds by then and he'll be just fine.
Yeah.
But I think on the way there, MicroStrategy stock might be in trouble simply because he's losing investor confidence.
Yeah.
And a lot of those probably don't want to wait and see what happens
Sure.
in 2025.
Sure.
Yep.
Sure. So walk me through the last one. You mentioned on the opposite side of that pair trade is ETH.
Yep.
So the Grayscale Trust, so DCG. Walk me through that side too. What's your logic there?
Yeah. So DCG has been another name that's been coming up more and more in, you know, because there was DCG, for those that don't know, founded with Barry Silbert. Barry, I think, founded DCG in 2013, you know, one of the true OGs in crypto.
Yeah.
And they have a couple different subsidiaries, right? So there's one subsidiary called Genesis, right?
Yeah.
And Genesis is a trading desk, a lending desk. And Genesis lost an insane amount of money this year. I mean, they lent money to Three Arrows, which they lost. You know, I think they had some involvement in Luna with Celsius. I mean, I don't know all the individual ones, but like they pretty much touched everything that was slightly toxic.
Yeah.
And in the process lost at least, I think, 1.6 billion, something to that tune.
Yeah.
And now the question is, you know, is Genesis solvent? And the reason that's a question is because, for example, people started redeeming money from Gemini Earn, right, which the Winklevoss twins exchange, and all of a sudden withdrawals stopped.
Yeah.
And then people are like, what's going on? Well, Gemini lent money to Genesis, and Genesis froze withdrawals because they probably don't have the money. I mean, they're still working through. They just made a statement like, hey, we just need more time working through financing, right? But that company's in trouble, right? Now, if you go up to DCG, what else does DCG own? DCG ironically owns CoinDesk, which was the one that leaked the story about SBF, right? Now back to DCG, they own another company called Grayscale. And Grayscale is the biggest provider of exchange-traded products for the crypto space. And so they got two products, they got a lot of products, but two in particular are GBDC, Grayscale Bitcoin Trust, and ETH, the Ethereum Trust. Both of these own about 3% of the entire supply of the respective underlying asset, which is a lot. So the irony is that they're trading at insane discounts. So a couple of days ago, for example, ETH was trading at a 60% discount to NAV.
Wow.
So essentially, you're able to buy Ethereum for 40 cents on the dollar. Now, why is that? The way these trusts are structured, right? Because they're not ETFs, they're trusts, right? Initially, individual investors, like accredited investors, institutions, and so forth, were able to subscribe via private placement to these trusts. So for example, like I could go and say, you know what, I'm going to send you 10 so let's say 1,000 ETH, and then I get 1,000 ETH worth of ETH in shares, however, initially with, let's say, a 6-month lockup. And after that lockup, I could sell. And that was really attractive initially. Why? Because there was a premium, actually. In the early days, you had like a 900% premium where, you know, the trust would trade 10x above what it was actually worth. Today, it's the inverse, where it's trading a discount. And people want to, you know, why isn't the discount getting fixed? It's because you cannot redeem. So money can flow in, but money cannot flow out. And so the reason, you know, I am bullish these trusts, and there's risk involved, of course, is that there's multiple paths to redemption. Number one, virtually every single bankruptcy that happened this year had exposure to GBDC or ETH, right? So for example, Three Arrows had a lot of exposure to GBDC. A lot of these desks, like whether it's a BlockFi, Celsius, and
Voyager,
so forth, right? They bought these. Why? Because they tried to do these NAV trades initially where there was a premium. They thought, hey, we'll take our customers' Bitcoin, we put it into Grayscale. 6 months later, we cash out at a 30% premium. We made a profit, right? And that's kind of where some of these yields came from too, that they were paying out to people, right? Except it became a discount. So now all of a sudden they're like, damn, you know, we took our customers' money, and if I sell today, I'm actually losing 60 cents on the dollar, right? And actually, well, that's how we got here, because although he started selling and selling and selling, and there's not enough buying pressure in the market, which forces the price lower into more ridiculous range. So reason number one why I believe like there could be a case for an unwinding is if there is enough regulatory pressure, because all these bankruptcy courts will say, listen, our goal is to make as many investors whole as possible. The reality is right now, you know, we can only get 40 cents on the dollar for an asset that should be worth $1 on the dollar, right? And so if you want to improve the situation, maximize investor protection, then we need to kill this product or make it an ETF or something, right? So there's going to be more pressure, right? So that's number one. So there could be pressure on regulators, which then put pressure on DCG, or there can be pressure on DCG. There's already the first lawsuits against DCG for, you know, pretty much creating a toxic product, and toxic from the angle that it is their ability to forbid redemptions kind of guarantees the management fees into perpetuity, right? So they make the management fee doesn't matter forever and ever, and people can't leave, right? That's an amazing business model, but it's not the best for investors, right?
Yeah.
And then third, of course, is maybe DCG itself deciding, hey, you know what? We own a lot of they themselves own an enormous amount of GBDC and ETH, and so did Genesis, right? And at some point, they might realize, you know what? We will likely make more money by allowing, there's like a Reg M relief, like for example, by allowing that, where people can voluntarily exit out, because now all of a sudden, let's say they make, they triple their money in their own product versus hoping to make, $100 million, $200 million a year. I think it's about $200 to $300 million a year in revenue from the management fees, right? So it's like, do you want to make $300 million a year from the management fees, or do you want to make, let's say, $1 billion now by having, opening it up and allowing yourself even to redeem it? And then the final point, and that's worth noting too, I think it's starting to get attractive enough for activist investors to get involved, right? If I'm not in that position, but like, if there's a multi-billion dollar, activist investor out there that says, you know what if I buy up over time a large chunk of the ETH out there? What if over time I buy up a large chunk of the GBTC out there? Right? And then what if I make an offer to Grayscale and say, listen, I'm going to buy Grayscale for $1 billion, for $1.5 billion. I mean, there's some of these numbers are being floated around out there, right? The reality is they could probably over time, right? And OTC and so forth, that they do it correctly, acquire, let's say, $3 billion worth of GBTC, ETH, and so forth, then buy the company, right? And at that point, they can do two things. They can either say, you know what, let's wait a year and earn another $200 million worth of management fees, and then unwind. Or they could say, like, let's kill the product, and I can instantly arb. $3 billion will probably turn into, let's call it $7 billion, not 9, because the market will dump too as that happens, right? But it's like the ETH, for example, will go from 40 cents an dollar to $1 a dollar, right? And let's say ETH will go from 1,200 because of that unwinding down to 1,000, right? They would still make a massive margin, right?
Absolutely.
And so that's such a rare opportunity that with every percentage point that the NAV goes lower, it's becoming more and more attractive for an activist position like that. And people might say, oh, but why hasn't happened yet? Well, in August, the discount was only 20%. Nobody's going to take that risk with 20%. But at 60%, I mean, it's a completely different ballgame. And so, I think there's many roads lead to Rome. And so, like in this case, I think there's many ways for that NAV to become more normalized. And equally, I think there's a lot of fears priced in where people say, oh, what if DCG did the same thing that FTX did, right? And the tone of my voice will sound silly in case that did happen. But it's very unlikely for that to have happened because, against US-based, the money is parked on Coinbase, publicly traded, and so forth. Coinbase has historically been super clean. They probably wouldn't want to be involved in that. And from that angle, if DCG or Genesis all of a sudden announce, you know what, we found financing, we're good again, it might recover from that just as well, because people were concerned that what if there was commingling? What if the Grayscale assets were spent, right? And so, I think those are the last 4 hurdles we need to go overcome. Like, people need to get clear that, hey, Binance is okay. Silvergate, once earnings come out, we'll have a better picture of like in what shape is the company, how much impact can it have on the industry. Microstrategy, it's kind of looming there, but really it only impacts Bitcoin. They own about 0.7% of the circulating supply. And then DCG, I would say we're maybe another 2 to 4 weeks out from knowing clearly what's going on there. But it is worth noting DCG as a company has a lot of value. I mean, their portfolio is massive. They backed everywhere from Coinbase, CoinList, Abra, and so forth. And so it's not, it's not just a worthless shell.
Yeah, correct. And one of the things that we've been looking at is, and that we talk about a lot, is like psychological indicators. And so we talk about like taking the contrarian bet here. And so we've been tracking short volumes, and specifically short volumes on crypto equities. So some of these equities that we're talking about that we've mentioned, there's 25% short interest on Coinbase currently, 42% short interest on MicroStrategy currently. And then now it's becoming the overcrowded trade. There's a 54% short interest on Silvergate.
And that's even a little bit lower than like 2 days ago. 2 days ago, I checked, it was like 68. Silvergate is the second most shorted stock in the market right now. It's about like, and that percentage for those, that's a float, right? So 68% of all the Silvergate shares existing were borrowed to short, right?
Are being sold short. And that creates an opportunity for short squeeze.
Short squeeze, right? And it's not just isolated to equities, it's also in crypto. So for example, Solana got a lot of pressure because of its connection to Sam Bankman-Fried and the FTX crowd, right?
Yeah.
And currently, real time right now, people are spending 0.28% every 8 hours to short Solana. So that's about, people are spending let's call it, 0.75%, almost a full percentage point to short Solana. But here's the funny thing. That's down from 5% every 8 hours.
Wow.
At some point, people were willing to spend 5% every 8 hours to go short Solana.
Yeah, that's crazy.
And so when the short interest is so damn high, it only takes a little bit of market recovery, a little bit of good news, a little bit of active investors buying things
to move the market enough.
Move the market enough where you can start having these short squeezes cascading to the upside.
Yep.
Because, I tweeted this the other day, I was speaking with a prospect, and even though we've been doing well with our shorting, we weren't shorting enough. Usually people tell us, oh, shorting is dangerous, don't touch it, and so forth. Now it's the opposite. Now it's the opposite, where people are saying you're not shorting enough. I'm looking for almost like a short only fund. I'm like, oof. You do understand that there's a lot of risks involved with shorting, right? Especially like if you don't hedge out the beta, like if crypto just goes up a little bit, right? There was one day, for example, where Axie went from $6 to $19, right? Like if you were short only, so to say, you'd have been done, right? And so my overall view, right, for kind of the next, the mini outlook for like the first half of the year is shorting is overcrowded now. I think, a lot of last minute tech selling, even though nobody made money last year. It was funny. You could see that a lot of symbols, for example, like Solana was selling off to $8 before New Year's, and then all of a sudden rebounded to 13, right?
I saw that.
So that's behind us. A lot of these fears, as we just discussed, these big four companies, it's slowly fizzling out. My perspective is that in H1, we're going to see a relief rally, mostly motivated by short squeezes, to be honest. And short squeezes followed by people's false impression that we're in a bull market. Right. So I'm not saying that we're entering a bull market right now, but what I do think is that it's extremely possible. It's highly possible. And that's how I'm positioning myself. That's why I'm using these words. But of course, I can always be wrong. That let's say an Ethereum goes from 1,200 to 2,400. And some altcoins might go up 300% or 200%. And you might think, oh, wow, that's so much. No, well, some of these are down 97%. Right. So them going up 300%, they're still down 90%. Right. But over the last few months, liquidity has been drained. So it doesn't take that much money to move these things up. And we've got this weird dynamic right now where you've got the order book depth is getting smaller and smaller and smaller. The short interest is getting higher and higher and higher and higher. And so there might be symbols at some point where you only need to buy, let's say, $1 million to create a $10 million short squeeze, right? And so that's something I'm cautious with, which is why I'm kind of like moving away from shorts right now. I'm more liquid symbols, a little bit more cautious, because I think that's coming. And then again, people will get that wrong confidence saying, bull market is back, let's go back in. And that will likely make it go make that move go larger than you think. So for example, in 2019, we had something similar where Bitcoin bottomed at 3K and it went all the way to 14,000. But it did revisit 3K with COVID, right? And so people got ahead of themselves. And so something similar could play out, which means a little bit more on the long side now, but ready to kind of reopen those long shorts when the market gets a little bit too confident, because the reality is everybody's on the same page here. I mean, we're probably entering a recession. I mean, if we didn't change the definition of a recession, we would be in a recession.
We will be entering a recession. Yes, I think that's pretty safe to say.
Right. And so there's more pain to come, but I think for the near term, just the way ththings are playing out, there's a good chance that we'll get a relief rally fueled by short squeezes. One other dynamic I'm really paying attention to when it comes to the liquid crypto markets, and because this has played out many cycles in the past, and we did this exercise. I remember we sat down, it was like 9 p.m., and I said, go to CoinMarketCap, and there's a feature called historical snapshots, right? Because for context, Daniel was saying, some of these names that were really great in this recent cycle, right, they're cheap now. Like there's a good recovery. And I said, you know what? There is a risk that some of these will actually die. It never seems like that in the present tense, because how can they? They're immortal protocols, right? And so we went to the snapshot thing, and I said, let's pick any year, right? We went to 2017. And off the top 100, there was maybe 7 recognizable names, 10 recognizable names as of today's date. So okay, let's go 2019. And then 2019, okay, maybe there was like 15, this is still pre-DeFi summer. And then we said, okay, let's go to 2020. And then, okay, now maybe there are like 25 names, because you've had the Aave and there and so forth, a couple more, right? But still, 75% or so are literally irrelevant today. And so the crypto market kind of goes through these, filters through players pretty quickly, right? From layer ones that were relevant in 2017, let's say Neo, are relevant today, right? Or, for example, today, there's players like, Helium is like on the way down, and there's new players like Pollen. But before Helium, Pollen, there's something called Skycoin, right? That nobody remembers anymore. But I remember in 2017, I was like on boat parties hosted by Skycoin, and they were the big thing.
Which did the same thing.
Yeah.
And they were the first to market there.
And because of this dynamic, I've phased out of virtually every, we're very little exposure to dApps, so to say, tokens right now. Like anything that's not like blue chip, right? For a short period of time, maybe like 3 months, maybe 6 months, because if it's anything like the last cycles, one of three things usually happens. Old projects are the number one. They rebrand and they bring a new splash of life into them, so to say. That's always interesting, always good to pay attention to. One of the biggest examples of that was Aave. Aave did not used to be called Aave. It used to be called ETHLend. So it's called, the ticker symbol I think was like LEND. And horrible chart on Lend, but then they rebranded Aave, fresh start, new chart beginning, and it was up only, and they started building, shipping, rebranding everything. Great, right? So rebrands, important to pay attention to. Secondly, and also with rebrands, very, very relevant to say, a lot of times a rebrand is a complete pivot. A project might have been an Oracle, now it's a DEX. A project might have been, a layer one, now it's doing something privacy. I mean, like I've seen everything, right? And it's okay. I mean, if they went the wrong direction, they realize, this is not going anywhere, and they still have some treasury left over, it's probably better for investors to try something new that actually works versus just saying, I'm walking away, right?
Agreed.
So rebrand's one angle. Number two, death, right? It happens. I mean, like, as I mentioned, Skycoin, for example, massive market cap, probably the peak over $1 billion. I think it's at like 2 million right now, and for all intents and purposes, it's done, right?
Yeah.
And there's many like that. I mean, you could like pick any name of 2017 and there's a 90% chance it's not around anymore. And the third one is actually, having resilience in a bear market. A good example would be Chainlink. Chainlink, of course, was hot in 2017, but it actually hit a new all-time high maybe in like 2019. It was one of the only ones that kept building and shipping and delivering through the bear market, because ultimately, like an Oracle, Chainlink is an Oracle. It's one of the few things that every DeFi app, that everybody needed in order to even function, right? So like it was one of the first infrastructure pieces before another piece of infrastructure could work. And so that's kind of like how I'm approaching it, where I say, let me go very light on non-layer ones that, and those layer ones got to have traction, like for example in ETH. And I will only touch something if either I know that they have the funding necessary, the drive necessary, and so forth to stick around. If they have new ideas where they say, hey, there's a new sector coming, we're going to pivot into this, I'm okay with that too. Great. And if they are building, like let's say like a Chainlink where we say, like, hey, the facts changed. Maybe in the past you weren't able to monetize it. Maybe now you have a way to monetize it. Great. That's now an opportunity to go in. I'm definitely putting on the lens of value investor more and more. That's why I've been reading lots of books on that too. And I think there will be opportunities for distressed assets, but I would push it out maybe another 3 months.
Yeah, I love that. I love that take. Definitely on the same page you are. I want to switch the gears a little bit now to a fun announcement, exciting announcement that we just made. We are running our first SPV. And it's through the Metaverse Fund. It's through one of our favorite investments in the Metaverse Fund, Red Pill VR. I love to compare it to the scene in Ready Player One, or multiple scenes of the Oasis, and it looks literally just like the Oasis in Ready Player One, literally identical. So Red Pill VR SPV, walk me through it, aka the Oasis.
Yeah. So, we've been talking about Red Pill quite a bit. We've had Laurent on one of our webinars. We hosted an event together doing NFT NYC. One of my proudest portfolio companies. Ultimately, what Red Pill is, it's an infrastructure stack for hosting events in VR, in the virtual world. They do everything from the creation to the distribution to the monetization. And so the way I describe it, especially because people here care about outcomes, right? Like where can this thing go?
Correct.
I always have kind of 3 cases where I would put Red Pill.
Okay.
Present tense, where it's already now, what it can serve us today is kind of like a middleware stack for the virtual event space, right? So analog would be something like, a Live Nation, except for it's for VR, where people use it in the background. You will, as a user, probably not interface with it directly, but people use it, again, for the creation, distribution, monetization of virtual events. So everything from music festivals, DJs, circuses, fashion shows, conferences, anything like that can use Red Pill and benefit from it. That alone has a huge TAM. I mean, that alone can be a revenue-generating machine. It did take Red Pill, a number of years to get to the level, like you said, like it looked like the Oasis. to get to the technical level where you have spatial audio, to the level where you have, servers, shards with, let's say, 100 people on at the same time, where you have cloud rendering so that you can access this beautiful world with just a standalone headset. Like, all these things are like technical challenges that like could be individual companies, and a lot of these companies are not even pulling it off themselves. And so they had to build 100%. So much. And the cool thing is now they're there, right? These things are built, they're done. And now it's kind of we're in the phase of moving towards business development, shipping, bringing the money in the door, right?
Yeah.
So that's kind of like outcome number one. Another outcome I see is, let's say, Spotify 2.0, where on Spotify, you have your playlists, you have your radio stations, and so forth. Now in the future, any artist can have like a 24/7 stage, right? Where even while they're asleep, even when they're, even posthumously, once if somebody's dead, like let's say Nirvana, big fan, right? There could be Nirvana stage where 24/7 I could attend a real show, right? Where you could probably, that feature is not live yet, but in not so long of a time, you can probably feed in old recordings from Nirvana, like live shows, and then using AI, can have a full-on, like, authentic reproduction. And the cool thing with the AI aspect is that it's not a recording, but instead, every single time will be a little bit different. He'll hit the notes different. Maybe one time it's acoustic, one time it's electric, one time, every time it's different. And so that is massive in itself too. Then it's like a whole new, whether it's SoundCloud or Spotify, that's a huge angle. And then the third angle, that's like the biggest outcome, would be nonlinear social. The two biggest VR companies right now, well, VR content companies, are VRChat, worth about 1.5 billion, and then Rec Room, worth about 3.5 billion during the last raises.
Right.
Why? Because kids, like after school or whatever, like, they want to hang out, and they're going to hang out in the virtual world with their friends. And those trends exist today. Rec Room, I think, has 3 million monthly active users. So traction is there, right? But when you look at what VRChat and Rec Room would look like, it's worlds apart from Red Pill, right? So if Red Pill can get to this state where there's enough content and exciting things to do, right? Which, by the way, it does need to accomplish the other ones, right? Then it too can become a nonlinear social player where you have millions of users spending time there. And I think those things will be the evolution of the next social networks.
And that's why I say that it looks like the Oasis, and it feels like the Oasis, and it operates like the Oasis. But compared to the valuations that you just gave us for Rec Room and VRChat, which is 3.5 and 1.5 billion, the valuation for Red Pill is 20 million.
It's 20 million pre, raising 5, and awesome big craft.
It already feels so much better.
And the good thing is, product is live. And so, like, anybody that wants to demo it, as long as you have like a gaming computer, a VR headset, go check it out, go try it out. There's VR stations in New York, in LA, in Miami. If you're an investor, of course, you can speak to us too. We are raising this SPV. We are the co-lead investor. It's Bitcraft and us. We're putting in 2.5 million for this initial close, which will power, the full raise will power Red Pill for 2 years. And I think in 2 years, both the world in general, and macro, and VR will look a lot different. And I mean, we can dive a little bit more to VR because there's a lot of big announcements coming too.
Anything else on the term sheet real quick for the SPV? Round is closing on January 20th, which is in 15 days. Anything else that we missed? Minimum ticket?
Like if you're, so if you're an accredited investor only, you have to provide accreditation verification to join as well. Send us an email, invest@hartmanncapital.com. And minimum ticket is $10,000. So it's very accessible. And so far this is our first one. In general, always welcome to join our investor network, because we'll be doing more of these, especially as our companies raise at higher, at further rounds. Always take advantage of our pro rata rights.
And so one of the things that we mentioned too is the way the space is going, the way that VR is going over the next 2 years, and some really exciting announcements just over the past few days. So CES is going on right now in Las Vegas. I don't know. Have you ever been to CES?
I unfortunately have not. It's been on my to-do list for many years. I tried to go in 2021, but they had very strict COVID guidelines. And since I already had, I believe I was in the process of moving to Miami, it just wasn't the biggest priority.
It didn't work.
But got to go in the future, because that's where the reason I didn't go this year is because it is more hardware focused for the most part. And so it's not necessarily fit for the investments we're making. But I mean, if you want to get a look of what's coming in the next 5 years, amazing conference.
Well, the reason I mentioned that twofold: one, Red Pill is there right now. They're there. They will be there. And two, it was actually announced HTC is releasing their new headset, and it's super lightweight. It's not heavy. It's not.
I think I saw some of the images, beautiful design, a little bit akin to Meta Quest Pro. So we're definitely going towards instead of these big boxes, thinner class looking a little bit.
That's not clunky. It doesn't bang around your head. It's very thin, very pressed on, and that way you don't feel like you're out in public and you look like an idiot with this giant box on your head.
Yep.
Which is a huge point of why many people hate VR anyway.
Yeah, I mean the form factor improving, and I think there was a leak again today from this week from Apple. I mean we've brought it up before. You know, at first there was a leak that Apple has the XR OS coming. You know, and now there was more leaks saying that of kind of talking about what the headset looks like. And so I have here Apple's XR headset is set to be built from aluminum, glass, and carbon fiber.
Yeah,
and it's compact and lightweight. That was kind of the description. So first of all, why is it relevant? Because you know, Metas are made like plasticky, they're kind of low quality, and that already sounds a lot more high quality production, the kind of branding that Apple's always good at, right? And it says the headset draws power from a waist mounted battery that can be replaced during operation. Also relevant, why? Because from what it sounds like, they're not trying to pack as much as they possibly can in the headset, but rather are using other ways to, for example, power it, right? And also that it's compatible, for example, with your AirPods. So you already need a lot less audio tech in there. And so the hope is that Apple nails it just like they've done all the other product designs, from smartwatches to tablets to smartphones.
And then even they could make the market like they have done over the last 15 years. And so that's going to be really interesting to have. But my favorite feature of the new Apple headset is actually they're showcasing the connectivity to all of the current iOS apps. Yeah. And that's something that we've talked about on the War Room before, where it's like you can do everything you can do on your iPhone now in VR for whatever it is that you want to do. Yeah, which is really cool.
And that will likely also lead to a huge wave of content. Oh yeah. Because my guess is that if Apple does it just like they've done in the past, it should be fairly easy portable from other devices to that. So for example, if there's a great app that allows you, for example, whether it's note taking, whether it's whatever, right? Yeah. That you can also now use an XR. So it probably, let's say within a span of 2 or 3 months, a lot of app developers that have already built apps for watch, for smartphone, for tablet, and so forth, can make a few changes and make it workable with XR.
And that's a really good point that you make, because to use as an example, gaming, computer games, console games, they've been around for decades, years. But the highest sector of games that are played, most used, mobile gaming, that's relatively new. And that's because Apple created a market there.
Well, what's interesting with Apple too is that Apple almost always comes into the first with productivity. And then that's like the Trojan horse to get people gaming, right? Like people bought smartphones because, and like when you look at Apple apps, Apple ads, right? They're like let's say the tablet, you can learn piano from it, you can paint things on there, or like you take it to your office meeting and so forth, right? And it's like it's kind of the gateway drug where professionals would think, because it's always like be great, be innovative, the great minds, blah, blah, blah.
The best technology.
Right. And like they ask with like Gandhi and everything, like what Steve Jobs did best, right? Correct. And so then people are thinking, well, if I'm this forward-thinking person and like I need these things, right? And so you can buy them. And then, of course, will they be gaming? Absolutely. Just like our phones turned from productivity devices to all of a sudden it's a gaming device.
100%.
And 100%. So in one final thing to that too is that the branding, I think, of Apple is a lot more mass friendly than Facebook. Facebook did not have a good reputation to start with. They had privacy concerns. Zuck is not the most liked person in the world in general. And so if anything, Meta provided a lot of funding. Meta provided a lot of firepower, but they didn't necessarily help the branding, because then people also said, do I really want to live in a world owned by this big brother, so to say? But I will say, to give some credit where credit is due, Zuck used to never do podcasts, and he started going on podcast tours where he's been on like Rogan, like Friedman, and so forth. And the more I listened to him, the more he's been like normalized to a degree too. And like especially like, hey, also like maybe you don't like the guy when he's up, but now that Meta's down a lot, down like 80%, 75%, you're like, I think he's become more human. Right.
I agree with
and
that.
So, and that also reflects in the business approach, where they no longer, at first they did like, let's hire every VR studio out there. They not hire, acquire, right? They did this mass acquisition just to rip them out of their seats and put them to work on Horizon. Now they're saying, you know what? Maybe let's build an ecosystem instead. Like let you support you in building something meaningful.
And they're encouraging their developers to build whatever it is that their developers are passionate and inspired by. Inspired about. So lastly, just to end here with what's been going on in the firm, what's been going on at Hartmann Capital the past few months. We mentioned things have been kind of quiet, but we have taken up a new endeavor. We've been reading a lot of books. I kind of went earlier. I've tackled both Howard Marks books, What have you been reading that you've liked that you really find insightful?
A lot. You know my bad habit of like, starting 10 books at the same time,
Oh, yeah.
going halfway through it,
Yeah.
getting what I need, going to the next one.
Yeah.
But now for this year, I have the goal to read one book a week.
The whole thing?
The whole thing.
You mean like from start to finish?
Start to finish, actually.
Wow.
Yeah. Where like day 3, I finished my first one. It's a small one. It's called The Acquirer's Multiple. It talks
Yeah.
about, deep value investing.
Yeah.
Finishing up, another book I already started reading, which is Dead Companies Walking, a book
Yep.
about short selling.
Yep.
Also in the middle of almost more than halfway done with A Man for All Markets, the biography of Ed Thorpe, incredible fund manager back from
Nice.
70s, 80s, 90s, and so forth.
Yeah.
But there's a massive list of books that I already set aside, like the next 50 essentially,
Yeah.
covering everything from venture to tech, books in AI and so forth on the
Yep.
metaverse, virtual society,
Yep.
To global macro options, everything. But to me, it's important because I realized I used to read a book a week
Yeah.
from like 2019, 2020.
Yep.
But then the bull market came.
Yeah.
And for the last 2 years, I've barely touched books because it's been very hard because I'm already running 24/7,
Yeah.
like between managing the book, running a venture fund, raising capital, operations, and so forth,
100%.
doing crazy growth. But I think it's important, there's a concept in 7 Habits of Highly Effective People, which the final one, 7th one, which is sharpening the saw, right? Like you can keep cutting a tree and cutting a tree and cutting a tree, but after a while you might not make progress. Why? Because the blade is blunt, right? So you got to walk away, take 10 minutes off, sharpen the saw, go back, and you'll do it in half the time.
Yeah.
And so if there's ever a time to like focus on growth, meaning personal growth, internal growth,
Yeah.
it's probably now when things are calmer and slower.
100%. And we've been talking about that. We've talked about that all week. We're both on sabbaticals from Instagram currently. Go ahead.
Yeah, no, so I was going to say, like, I went on a full-on dopamine detox.
Yeah.
Killed Instagram, killed TikTok, killed YouTube.
And then the best part of the dopamine detox. Tell us what the best part of the dopamine detox is.
The best part of the dopamine, the most ridiculous one is I made my phone screen grayscale, black and white.
Oh.
So why? Because the colors, they release too much dopamine, right? So like no social media apps, no color.
That's psychotic.
I also deleted Uber Eats because I was ordering way too much bad stuff. So I'm making food for myself again.
I tried the grayscale thing. I tried to do the black. It gave me a headache after like a few hours. I couldn't do it. I couldn't do it anymore.
Weak. You weren't meant for it.
I know. Yeah. I'll just take different kinds of sabbaticals. So yeah.
But yeah, no. So there's a whole list. I mean, ultimately, look. I mean, I think the whole new year, new me is always overdone, but it's always a great opportunity to just like take inventory, right, and say like, hey, listen, there's obviously a lot of things I did right last year or the last 2 years and so forth. Incredible growth since 2020, but there's also some things I want to get back to, from like reading every day, working out every day, having a healthy diet, removing distractions, because they will trickle down on everything you do, right? So for example, maybe it's those last 2 hours or that last hour at the end of the day that you're scrolling through social media that will rob you an hour of your sleep, because if you're less sleep, you're less sharp, maybe you're in a worse mood and so forth. And
100%.
so
100%.
super important, I think, to take that inventory. And what I've really loved is that one of the last thing we did for the year, I did a roadmap for Hartmann Capital, which that one I don't share publicly yet because I'd rather show you than tell you. But what I also did is I told all the guys, I said, hey, take a day off, take 2 days off, and instead, what changes do you want to make in your own life?
Right.
What kind of habits, what kind of improvements, what are other funds doing that you think we could learn from them? What do you think we did really right and so forth? Like all these kind of questions, like 10 questions.
Absolutely. Yeah.
And everybody worked on themselves and said like, hey, you know what? This is what I want to work on this year. This is what I want to get better at.
Super reflective. Great exercise. It was awesome. It was a great way to end the year and wrap up and then get to hear from everybody and hear like what everybody wants to improve both professionally and personally for 2023.
Yeah. Because I think, if all of us get better, 1% better a day, as a unit, the outcome's incredible.
Agreed.
And so
agreed.
Excited for what's to come.
Yeah, us as well too.
And so with that, I think we'll see you next time on episode number 6. A few quick disclaimers. All the information shared with you today is for educational purposes only. None of what we shared today with you should be construed as investment advice, nor is this an offering in any of our investment products. Furthermore, some of the assets discussed on this show may be held whether long or short by either us or our guests. As always, remember, investing comes with risk, so make sure to do your own research.